Hello, YouTube and X. It's your main man, BTM here, bringing you back to the BTM Crypto News Network. And we're waiting for the Fed to start the actual press conference. This is the Federal Reserve site. And I guess we'll just run these commercials. But let me know what you guys think. Don't forget to like, share, and subscribe. And super chat if you get a chance. But let's see. Let me know in the comments. What do you guys think? Will the Fed cut the interest rate? But I guess we'll see. I don't know why this is not streaming yet. But I guess we'll see what's going on. I'm tripping. Okay, let me start the screen share. And as of now, it's just a commercial. But we will see. Let me see.
Federal consumer protection and fair lending laws while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coins to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the
Not sure what's going on. They usually start on time. So I guess we got a couple minutes. Let me know what you guys think about the rate cut. Do you think they're going to get a full percent, a half a percent, 0.75% or 0.50 in the comments while we are waiting in these crazy Federal Reserve commercials? We definitely haven't started yet, but we're still waiting. When it was taking these guys so long. Why is it always a delay on the Fed meetings and the presidential meeting, right? Why these guys never start on time? I would think if anybody started on time, it would be the freaking Fed or the presidential addresses. I'm not sure what has been going on lately and what is going on with this meeting. Dang it. So I guess we wait. So let's see here. That's crazy. 1 a.m. and still nothing going on. I've started a little early here. What the freak? Guess we can. That's weird. Just now to find something to do to the freaking.
Yes, yes, Joseph.
Wow. All these sites and nobody's meeting. Everybody is waiting.
Let's move it. Let's move it, Jim. Who there? Yeah.
Here, real Fed funds rate being neutral at 1% and call 0.9, restrictive in the sense that it's going to prevent inflation from moving substantially higher. Doesn't really uh, doesn't really add up. Stormy, appreciate you coming out to the afternoon show. We'll see you in probably Fridays out. So see you back then. There's 9% on the real Fed funds rate. Just is kind of a head scratcher. I would think that inflation either needs to run cooler than their projections and they'll just be wrong about the projections. And in theory, right, if we know that PCE is actually running at a 2 point, right? If you have a 2.5 and a 3.9 here, obviously that gives you a bit of a different look at the real, excuse me, at the real Fed funds rate, right? So that's a way to frame. What else do we care about, right? Let's take a look at where do we want to go. I think we want to move down to the dot plot next. Here we go. Wow. Okay, this is actually kind of, I don't
Yeah, I
want to
didn't
say
really have
crazy.
anything set because I thought that they were going to start the actual meeting on time. So I guess we'll go to this guy. Seems to be talking uh, about something while we're waiting. Not sure what the news is or why freaking meeting hadn't started yet. But we'll see what this guy's talking about in the interim.
Tough. It's not a great look there. Let's scroll down and let's see where they have. We want the projections to risks. We don't want percentage range. We just want their risk assessment. Here we go. Risks around GDP we don't care about. Risks around the unemployment rate. Okay, so you can see that the unemployment rate risks have backed off relative to the March projections, right? Risks have moved down this delta and broadly balanced here. That is a sustained check mark for the Fed to basically have the ammunition to say, hey, no problem. We're basically going to keep rates the way they are because we do not see the risks as being elevated to the unemployment rate. And we actually just read that, right? Via the strike through here, they took it out. Risks of higher unemployment and higher inflation have risen is not included in the statement. If we go back to the SEP, let's move on down. Next one should be inflation. Yes. Inflation risks have also somewhat come down. However, you can see that they are still weighted to the upside. So I don't think, we should definitely talk about the delta of the move and the revision in the downward direction. However, it's still outweighted to the upside. You're still seeing risks there. Same thing on the unemployment rate. So although they're not elevated or risen, they are still relative to being broadly in balance and having a column that would look more so like this and like this. You can certainly build the argument that the Fed is still concerned about inflation, even though the last report seemingly was pretty solid. Let's continue along and take a look at, if we go down here, where is it? No, I don't want this. What are we looking for? I don't want the diffusions. Maybe it's not there. Oh, this is it. Is this it? No. Hmm. Is it at the top? What I'm looking for is, I guess, yeah, it's this. This is what we're looking for. Yeah, there it is. This is what we care about. So this longer run right here is unchanged from prior. You can see a majority of participants really feel as though that 3% Fed funds rate is looking good. Remember prior, though, what we had was, and the reason that it was so important, let me actually go back really quickly. And I'm keeping an eye on the clock, don't worry. Let's open up the June, but we also want to open up the March projections. So So let me go into the March projections real quick here. And where was the longer run? Longer run. This is unemployment rate. What we're looking for is Fed funds. Is this where it's at the bottom? This one might be where it's at the bottom. Unemployment rate, PCE inflation, PCE inflation, target range. One of these releases, it could have been the previous. Maybe it's been that long since we got the SEP. It's been 2 months. Let's go back to this one. We want the December of last year. What I'm trying to find is where there was someone in the Fed who said, hey, we think that the longer run curve needs to be higher. Okay. Here it is. Right? This is to say, nope, we got higher. That's what we're talking about there. And you can also see in the longer run section, right, this bump up over here. Very subtle. Very, very subtle. But that was where we were like, okay, there's someone out there in the Fed who's actually quite hawkish. Someone out there who is more hawkish than they are dovish. So anyhow, that's the subtle change we were looking for once again for today's release. I think the dot plot sort of speaks volumes here in terms of the participants really seeing that 2025 should have an elevated Fed funds rate, right? Sort of keeping it where it is. This indicates once again 0 rate cuts. If this SEP is accurate, that is 0 rate cuts for 2025. So we'll see how and where Powell sort of acknowledges different people were voting. But that's that. That is that from the actual document. So let's flip back on over to the charts, and then we'll just continue to sort of watch these charts develop ahead of the actual press conference from Jerome Powell. We've still got about 15 minutes to go until that takes place. Let's jump on over to Thinkorswim here. And you can see, right, as we're just looking at the ES again, for the most part, the price acceptance remains underneath the 60-60 area. I would expect that as Powell comes on, we possibly test and interact with this and then get some sort of more conclusive feel for whether or not the day will close over or under 60-60. Recall also, if we just go back to the SPY daily chart for a second on the split screen view, we really just want the resolution of that level. Do we resolve it higher? Do we resolve it lower? What's the deal with it, right? Can we stay above? Can we, can we get some acceptance below? Give me something concrete. Give me something concrete. Some other interesting things to watch here ahead of the press conference from Jerome Powell. Let's take a look at Bitcoin and see what's going on with the BTC. If we take a look at the intraday 15-minute time scale, you can see some volatility very similar to the market. And I think that my argument here just remains that Bitcoin trades as a risk asset. Bitcoin trades as a risk asset, nothing more, nothing less. If it was the Fed and you didn't really see any of this similar volatility, it literally is a mirror image of the NASDAQ, basically. Very, very similar to the NQ futures here. So there's Bitcoin. Coinbase was on an absolute tear from today's session. This has something to do with the passing of that. I'm going to butcher it. Someone who's more involved with legalese will be able to correct me in the chat, but I don't know if it was a bill or an amendment or an addenda or whatever. Something was passed, right, that sort of spurred on some catalyst here to the upside out of Coinbase. And the reason we know it has much more to do with regulation and law is just simply because if you look at Coinbase and then you look at something like MSTR, MicroStrategy didn't even budge, right? So yeah, the stable coin, the Genius Act, yeah, bill, is it a bill? It's technically a bill. Appreciate my chat, guys. So again, regulations, functions, and the strategy for things. Let's go ahead and take a look at, let's continue through some of these charts here. Let's go over to the NQ futures as well. Let's stay on these widescreen 5-minute charts. They're nice. Let's go to the Q. And then again, folks, we'll have Jerome Powell. We'll beam him into the office here in the next, we've got 14 minutes until Powell shows up. And we'll put him right here on the screen. Don't worry. You'll be able to listen to him. You'll be able to see him. And then once again, courtesy of Amy S. in the chat, our very own Amy was able to build us a bingo card. Check that out. And we'll see how it goes. NQ, similar story, and once again, very similar to the Bitcoin chart, where you get this big downside off the open, rally, fade it all, and this volatility on the Fed. So I don't really think that we don't have anything so outstanding here from the updated SEP. I think all the SEP really outlines is there's the Fed is just in the like this pause mode. And you could say that they're always in pause mode. You could say that they're always in wait and see according to the data this, according to the data that. But that's really you can read a little between the lines. And I would say currently the lowering of both the risks to inflation and the unemployment rate, that's about as neutral as it gets. If they only did a one-sided lowering, remember thinking back to that SEP graph where we saw like broadly balanced risks, elevated risks, like this, the unemployment rate. We would have learned much more about the stance of the Fed chair and as well as the participants there in the FOMC if we had more substantially. Let's just say this is risks to I'm going to say unemployment. So unemployment rate, and then over here if the PCE looked more like this. Let's do this, and then maybe something like this, and then prior was like this, and then like this. Just an idea, and we'll do something that looks like this. This is my beautiful drawing of the SEP. This is risks to PCE, aka INF, our based homie who is here in the chat today. If this is what it looked like, then absolutely the Fed is much more dovish, right? But considering that both ended up looking like this over here, it really doesn't, give the market much of anything. And I think that price action itself literally reflects that. Here's the 2 p.m. start of all this nonsense. You're almost back to unchanged. I would not say that the SEC update here has given any major indication as to the way the Fed is sort of leaning there. Why is there no movement in Bitcoin? Simply because I think it trades like a risk asset, and considering that the broad market's doing nothing, I think it's just trading right in line with what it should be doing. If it was risk on and oh my God, the Fed's going to cut rates and the dot plot was totally skewed to the downside, if the dot plot looked opposite to how it currently looks, and we did see risks of PCE lower, meaning inflation risks are a non-issue for the Fed, then we would probably see rallies in Bitcoin as well as the broad market here, as the market basically expects monetary policy and monetary financial conditions to ease and offer perhaps more liquidity to the system, right? Lower rates would definitely increase that. CLRDRJR again says in all caps, screaming in my ear, as if we weren't up here in the office standing next to each other and I couldn't hear you the first time, says Powell does not single-handedly lower rates. Learn how the FOMC works. Well, I don't know if you were here just a moment ago, but we literally talked about the dot plot and how the median projection is what determines where the Fed is going to move rates. So I appreciate you, but all caps in my ear, I can hear you just fine. I can hear you just fine. I appreciate that. That's the other comments in the chat. I appreciate the sentiment. All right. Okay. So, I mean, really, there's not much to do in the market ahead of Jerome Powell speaking. If you're putting on big risk here in 10 minutes to go before the Fed starts yapping and Powell starts chirping, then I don't know. It's just not really, I don't think it's much in terms of an actionable idea. I think you're just sort of like throwing darts at the dartboard and seeing what sticks. The decision is made by the Federal Open Market Committee, the FOMC, which consists of 12 members, 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York, and I imagine that the rest of the message got cut off there due to length, but that is cool. Abdo, I can hear you loud and clear. Siege is on it already, but all right. Let's let some of that be there a little bit, and let's have ourselves a good time here this afternoon. Siege says, I'll be removing all caps without even reading what it says. So your warning has been issued. All right. Okay, getting a little bit more serious about analysis, waiting for the Fed. Yes, we hopefully won't have any audio glitches with the Fed when they start talking. I've reset and tested the audio before the stream. I remember, yes, there was indeed last time an issue with the audio stream last time. So we'll get that straightened out. But all caps. It's killing me. It's absolutely killing me. What are we yelling about? The audio should work, no problem. All right. We did not get YouTube Premium. I probably should do that. But if the Fed runs ads on their channel live stream of Powell, then I'm gonna go walk down the road and have a bone to pick with Mr. J Powell and say, hey, cough up the Google ad revenue and give it back to the people. Right? Let's add it into the balance sheet. Imagine. Can you imagine that? Hey, Powell, we saw that you were running ads on the YouTube live stream. Would you mind throwing the total sum of that, all $25, into the balance sheet? We'd really appreciate that. Thank you. So we'll get into that. Okay, 8 minutes, 7 minutes to go until Jerome Powell takes the stage. I think what we can do in the chat is we can start to have a little bit of fun with the poll. Of course, the poll in the chat is always going to be about our tie color for Jerome Powell. Let's say, what color tie? I mean, someday it's not going to be purple, and everybody's going to be blown away. Let's go purple first. Let's go red. And it also just started here in the nation's capital, for those who don't know. That's currently where we're stationed. It just started downpouring. We got a little bit of thunder rolling in here. So it's going to be a little bit of an ominous Fed meeting here. I love it. Purple, red, blue, and of course, green gets thrown on the poll list as well. Let's start that poll. You should officially be able to participate in that via the chat right about now. The market is coming down a little bit more so away from that 2 o'clock origin of the move here. And again, the SEP has not really revealed anything big. I think that, and we should know this too, based on the commentary from Powell and a couple of his other speaking engagements. He's basically told us, and if you read the Fed Beige Book, which I'm not expecting everybody to go out there and read the Fed Beige Book, it's the most boring thing in the world, but if you just quickly skim it, right, basically what all of the Fed governors and Fed economists who are in cahoots with the different businesses out there in different regions of the US, they've all agreed that basically within the next 3 months, and this is coming back from earlier in May, in the next 3 months, they will pass along price increases to consumers should it be necessary. So where does that leave us? It, of course, is the end of August, EOA, end of August / early September. Okay, so I think the really neutral SCP is totally aligned with that. It would have been nice to see a little bit of a, a little bit of a telegraph from the way that they've balanced their risks here, but we just didn't get that whatsoever from the document. So, we could try to read between the lines as much as we want, but there's not much to read between as of right now, considering everything we've covered. All right, let's go ahead and let's take a look at let's bounce back to the ES here real quick. ES, let me just type this in, ESU25, there we go. And let's see where we're at relative to that 60-60. Still just bouncing around, playing ping pong in this zone. I would generally think, and if you guys follow along over on X, if you're not following on X, you could follow our X handle, which is linked. I think I'm pointing to it somewhere down here. The idea is, or was, if the market was going to remain constructive, we needed to hold up over 60-60. If we were to fall underneath, it's kind of all bets are off in this zone, which is kind of what we're seeing currently. So I would not really be thinking about big positions, this, that, the other thing. Manage your risk, manage your size. There's nothing to really do in here. Are there points to be had? Of course. Is there an actual edge in there? Personally, I don't think so. You're more at the whims of the market. If you want to try to scalp a couple of ticks out of it as it's moving around, be my guest. But that's that. Mr. Pickle in the chat says, SPY, get long or be wrong. For those who don't know Mr. Pickle, he is one of our perma bulls in the comments section and in the chat. Gene, we will have, again, courtesy of Amy, our bingo card, which does include the term good afternoon. My colleagues and I are squarely focused on blah, 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 blah. And then Powell continues, right? I could basically act as Powell. Give me the script. I will be Powell for a day. No problem. All right, let's go into a couple of these. One of the things that you could probably watch here as well. Let's take a look at the TLT. No breakdown underneath the 85. Oh, there's a nice flash of lightning. Nice flash of lightning here in the nation's capital. Let's see if we get a nice little boom to go along with it in the next couple seconds. No rumble yet. There it is. I know you guys can't hear it. But there it is. Oh, that's lovely. It's cozy. It's cozy. The skies are angry. They're getting ready to dump on Mr. Powell here. And we've got 2.5 minutes to go until the press conference should start. I'm sure we're probably getting elevator music on the stream there. Let me turn this up in my own ears. Yep, they've got elevator music going on right now. I will beam him in when the time is appropriate. Anyways, back to bonds. If Powell totally is like, hey, we're fond of heightened rates and restrictive policy. The labor market's a non-issue, and we really need to get inflation under control. If he starts gabbing along about, crude oil prices and the possibility of impact from that, I would expect bonds to sort of take a little bit of a hit here, simply noting that rates should be moving, or the forecast would be rates in the upward direction. If bonds start to break back down underneath the 85 handle, if we just let's go full screen on the daily chart for just a second. If we're underneath the 85 mark, I would start thinking about selling some puts again around the 80 mark, 80 flat, right? So selling there, looking to collect some premium. If the implied volatility really sparks, we'll see if Powell ultimately makes those comments. Minute and a half to go until he should take the stage. I'll beam him in when the time is appropriate. I'll just give you a little taste of what that'll look like here. There he is, right? We'll put him right there in the lower left. Okay, so nothing yet. Trust me, when he's on, I'll put him on. There's our bingo card. We can look at that as well in just a moment. Let's turn that off. Let's get through a couple more charts before we, of course, have to tune into the man, the myth, the legend himself, the Honorable Jerome Powell. Let's go back to this monthly, 1 month. So TLT is going to be rate sensitive. What else is going to be rate sensitive? Probably your XLRE, real estate. Real estate getting a little bit of volatility on the move, but nothing crazy. What about XHB? Home builders, some volatility here, but kind of unchanged as well. Nothing crazy on that. Amazon, I would continue to watch here. This 214.50 short. I mean, look at these daily bars. Pretty nasty daily bars, right? That to me is maybe an idea. If the broad market really starts collapsing, Amazon and then Google underneath these lows, 174.75. Those are the main ideas that I've been watching in terms of short side. Wouldn't really, sounds like the music is coming to a pause. Do we have, we have Powell. Let's throw him on. Let's turn the volume up. You guys start speaking. Let me know if it's too loud, too soft in the chat. Looks like it's a purple tie.
Good afternoon.
Can you hear him?
My colleagues and I
Let me know
remain
when the
squarely
volume comes up in the
focused on
chat.
achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market 2% is at longer run maximum. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy, strategy, and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country, research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effective tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about, responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you ended a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March. This is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April after the March meeting that substantially higher tariffs were likely, and then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time, and what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that they do. So and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that. No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about, cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that, the economy is weakening and that is a reason to cut rates going forward?
So we do, of course, monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of, basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very slow continued cooling, but nothing that's troubling at this time. But we watch it very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that, there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place? So
this is very much the conversation we had today and yesterday. There are many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And, meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
Yeah, what you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not, we have to be forward looking. And the thing that every forecaster, every outside forecaster and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months. And we have to take that into account. So I think a backward looking look would lead you to a neutral stance, but we can't, we have to look at that. And because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction. And I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers about the outlook for the economy.
Okay. From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair? And
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market?
Sorry, with what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? First is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. many other ideas. It's sort of, how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was 2.5%. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially larger than forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025. And that's a big part of the change. And that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, in consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. You know, from our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional, forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs. And it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind or just the consumer buying it, and all through that chain, people will be trying not to be the ones who pick up the cost. But ultimately, the cost of the tariff has to be paid. And some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past. So we know that's coming. And we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years there talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward looking. That is elementary. You've got to be looking at, I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again. Right. So it's always forward looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad. Right. So we took very aggressive forward looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this and they understand how they're going to go. And it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said, no, and I sort of said as a pun, overworked, but not overstaffed. People do work extremely hard at the Fed, and I know they work that hard at Bloomberg too. So, but we work hard. But I would say this, so we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had a lot of experience in my prior careers, with headcount reductions and things like that. And this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions. And I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks. Worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult. And it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair. And I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on.
All right, got a pretty good amount of questions coming on in the chat. First question. the president can't fire the Fed chairman. He could take it to the Supreme Court, and the Supreme Court could determine if the Fed chairman is not adequate, and they can fire him. So, yeah, there really is nothing that the president can do for getting rid of the Fed. Let me see. Pip, what's up with this ESX? Trying to figure out where to get that at. Uh, no cuts as December. You're right. The Fed again did not cut the interest rate. This is political. Yeah, he knows Trump wants to cut, so definitely he's not going to do it because Trump wants it. I'm not sure if it is mainly centered around Trump needing to cut, because until they cut the interest rate, spending is not going to move. And with spending not moving, we know, especially with crypto can't do anything because there's no funding coming in, right? Once the funding comes back, the crypto market will explode. With him not cutting the interest rate, it's slowing everything down. Like you mentioned, even small businesses can't get loans, large businesses can't get loans. There's another round of layoffs from businesses coming now because they can't get loans to pay their debt. So the only other way to accumulate profit is to lay people off. Yeah, Trump and Powell are at odds. Like, it is a big thing over here, right? This guy wants to do bodily harm to Powell because he won't cut the interest rate. Trump and let me say Taco. Stop saying Trump. The billionaires that support Taco want interest rate cuts so they can get more money. Without that interest rate, they can't really do anything. So we are at a standstill because people are more agnostic. Man, at that level, Powell is a multimillionaire. He's out of touch. WWE is inbound. He's fiddling around about inflation. Yeah, I agree with you. MVB. Trump, Powell's delusional, right? He wants to cut inflation. He's trying to break the back of inflation, but the interest rate is not going to help him, right? It hadn't helped him in all this time, but I think he's leaving anyway next year. So either way it go, there will be an event in September. Just watch and find out that we prompt a rate cut. There will be a prompt that will prompt a rate cut. I think he's probably going to keep pushing it, and if he does cut, it's going to be a small cut. This guy is set on not cutting the interest rates because he knows as soon as that half a percent cut or 30% or whatever it is, spending will go crazy. Nonsense. This guy sees hurricanes coming and wants to wait until they're damaged to see what action can be taken. I actually did see the hurricane, so I'm kind of weird. Dudes out of touch with reality of the working class. You're right. These guys don't have a clue what's going on. The Fed is a joke. Uh, what is it called? Yeah, the Federal Reserve's a joke, man. These guys don't care about what everybody else is doing. They just want to hold that interest rate as long as possible to keep that spending down. We need a president with balls who can fire. Like I mentioned earlier, the president can't really fire the Fed. He can recommend to the what is that? He can recommend to the Supreme Court, and the Supreme Court would have to make a decision. Biden got through to him. Biden probably working together, right? Because if I remember, I think Biden appointed him. Yeah, Powell can't be fired. The Supreme Court can ask him to step down. The federal chair is protected by some court ruling that happened decades ago and would have to be overturned. Yeah, the Supreme Court would have to do something to fire the Fed. And I don't think they're going that far. I don't even think they want to get involved in this. I think this guy is just here trying to break inflation, which he can't do. And it appears that the meeting is continuing on, but we're about to shut it down. All we wanted to hear is the interest rate didn't get cut. And stick around. We'll probably go live with ZBIC around 3:30ish. So let me know what you guys think about that. Don't forget to like, share, subscribe, and super chat. And thanks for joining. As always, let's get back to the money, guys, and stay dangerous. Miner out.